IMF Chief Economist Pierre-Olivier Gourinchas joins us now. So are you not convinced, Pierre, that inflation or disinflation is really coming down to target levels at this point?
Well, Sarah, we had a very good CPI report for the month of June, of course, and everyone has to acknowledge that. And it was very good news on overall inflation, but also on core inflation. But having said that, we've seen a few bumps in the road already in the first part of the year. And some of the underlying concerns are still there. In particular, I think when we're looking at services inflation, there is still a sense that services inflation could be pushing higher than really where it was pre-pandemic, and that could, in turn, push up the overall inflation numbers. And when we're looking at wage inflation, it's also been quite robust. Now, a lot of that is still catching up to lost income during the inflation surge, if you want. So it's not necessarily a source of worry. There's no wage price spiral or anything like that. But still a point of concern going forward. So I think we want to be prudent. We want to highlight that we've got a good month, but we got a few months that were not as good earlier in the year. And it could take a little bit longer than maybe the markets are expecting at this point.
Oh, so you're not in the camp of September rate cut? You think that's too soon to expect it?
We're more in the camp that there could be. We're on course for having some cut in the latter part of the year, but maybe just one cut for 2024 and maybe the rest in 2025.
Do you not think, though, that rates are restrictive and are hurting the economy the longer they stay at these elevated levels, and that's a potentially bigger risk right now than inflation remaining sticky?
Well, of course, this is the balance of risk that the Federal Reserve will have to assess. I mean, there are some signs that labor markets are cooling, and they are very welcome signs because for a long time, labor markets were very, very tight. We had vacancy and employment ratios that were very, very high, very elevated, and they've been coming down. But at the same time, unemployment rates remained quite low. So it's still a fairly solid labor market at this point. Now, of course, the Fed wants to be careful. It doesn't want to precipitate a downturn in the labor market that is not necessary. But it has to keep its eyes also on the inflation path. And right now, good news for June. We'll have to see what happens for July and August before I think they will be in a position to make a call for September.
In this outlook, you also, and you've done this before, but it sounds like are ramping up criticism or at least alarm bells around the U.S. debt and the deficit picture in a healthy economy and the kind of path that we're on. What is the risk here, and how close do you think we are to realizing that risk?
Well, to be clear, the fiscal situation in the U.S. is clearly sustainable. I mean, there are a lot of things that the U.S. can do to make sure that there isn't really something that gets out of control. So we're not concerned from that perspective. But where we are concerned is we're seeing in an economy, as I said, that is near full employment, that is growing quite well, we're seeing a fiscal stance that is quite strong, that is leading to increase in debt to GDP levels. We're seeing that while, in the context in which medium-term growth may not be as strong, in which interest rates are higher, we talked about what central banks are doing. So doing a little bit more on the fiscal side would seem prudent to us, especially since, in a sense, when you have nervousness in the market around U.S. debts, this has potentially strong spillovers to the rest of the world as well. So this is a risk factor we highlight, and we would wish to see a little bit more prudence on the fiscal side.